What's up, guys?
Hey, what's up, guys?
Welcome back to our channel, the place where we help new and struggling traders learn how to trade with structure and guidance. And today, we are going to talk to you about where to place your stop loss, where pro traders place their stops, what we think, what we do, and what you can do too. So let's get right into it. All right, so one of the things that we do, I'm going to hop right into it. So one thing, when you are thinking about where to place your stop loss, this is a common question we get from traders because a lot of traders don't know where to place their stop, their entry price, their take profit target. And the very first thing that we do is we consider our risk. You have to protect your capital. Risk management is
Yep.
everything.
So what should we risk?
Well, we risk no more than 1% to 2%. All right. And we've been at this for years. There are traders who I see risking 10 to 20% of their account.
Even 5 or 6% is way too
It's too
much.
much.
It's too much. And because if you're looking to do this full time or even just part time and gain consistent profits, you have to stick within the 1 to 2% rule.
Yes, and professional traders are doing that. They're sticking in that 1% to 2% rule. And so through the educational courses that we've done, that's what we find from our mentors who we learn from, who are successful. And I can tell you, we haven't always done that. Early on, I know when I started, Brian was trading much longer than me, but I was risking way too much. And it was because I hadn't been taught proper risk management. So the very first thing you want to do is making sure you're sticking to the 1% to 2% rule. And you take your total account balance. You risk no more than 1% to 2% of your total account balance, not per trade, your total account balance, okay? So why do you want to do that? Because that's going to keep you from destroying your account, from blowing your account over and over and over again, all right? So the next thing you want to do is what pro traders are doing, we only trade from the best levels, from key technical levels.
So you should ask yourself, what levels should I trade from? How do I identify those levels? And so we're going to talk about that, support and resistance, how to easily identify it. So, because this is also a form of risk management. If you get in at the best levels, it's rare that you will hit your stop loss.
So let's take a look at this example here. You'll notice that in this chart of USD JPY, this is on the longer time frame. And when we mark up our charts and we're looking at the best levels, we're not looking at the 5-minute chart because it's too noisy. We're looking at the daily, the weekly, and pro traders are placing their orders ahead of time. Rarely are pro traders using market orders where we're getting into the market instantly. We're looking at supply and demand levels, okay? So when you find an imbalance between buyers and sellers, that's where you're going to find the most powerful swings on your chart. For example, you can see on this weekly time frame, price tested this level once, it tested it twice. Look at this imbalance between buyers and sellers. And now once price came back to this zone again and tested it, it rejected twice, then it pierced through. So when you see something like this, if you look at the longer time frames, I can guarantee you that you will see these strong levels where you'll see these long wicks, all right, and you'll notice imbalances between buyers and sellers, and you will see where price will wick through a major level. Now, the reason why that happens is because either the bulls are trying to push through resistance or traders are finding liquidity just above this. So when we are placing our stops, think about it. If you're a bank and you know that traders are taught to place their stops right above the previous swing high or right below the previous swing low, how many times have you been in a trade, it wicked you out, and then price turned right back around? And you're like, where is it going? And why am I not in that trade? Okay, that's what's happening. And so you have two options. You can place your stop very close to a structure level, or you can place your stop far away from these structure levels. So when we're trading the longer time frames, we usually are doing about 150 to 200 pip stop loss. Now, why? Because also, too, we trade with a larger account than we did when we first started trading. So if you have a large account, you're going to have longer holds because you want to avoid getting kicked out of those minor swings, around these minor swings, okay? But around these major swing levels, rarely, if you look on your chart, rarely will you see that price will wick through these levels and wick like maybe on a GBP pair, but normally you're not going to find where price goes like past 100 pips or so. So that's why on the longer time frames, we're placing our stops far away from these structure levels.
Yep. While we're risking still that 1 to 2%. And so we want to make sure that we have enough buffer room. And in order to do that, you have to look at the 4-hour the daily and sometimes even the weekly time frames to clearly identify that key resistance level.
Now, if you are scalping, that's a different story. And if you have a small account. So if you have a small account, you're not going to be able to place a stop loss very far away. But one thing I can tell you, as I got a question today, is how do you keep from being stressed out when you day trade? And one of the things to prevent from being stressed out is using proper risk management. And proper risk management goes hand in hand with how you manage your stop loss, okay? So if you have a small account and if you're risking way too much, you're gonna risk blowing your account. But one of the things, or two things, main things that pro traders are doing is they're sticking to that 1 to 2% risk rule and trading from the best levels only. We don't use a lot of market orders. We set buy and limit orders to get the best possible price. And if we miss the entry into the market, we don't care because we know there's abundant opportunities for us to trade. So those are things that we wanted to share with you, a few tips. This is what we teach our students in the academy, and we do a lot of risk management practice to help because a lot of us aren't taught that proper risk management. So I have another example that we want to share with you, and let's just go through this really quickly because I want to share with you how we break our risk down. So let's take a look at this.
All right, guys, so we have an example here that this is the way me and Kenya like to trade. And we will have multiple entries. And so what we would do, here's the resistance level here. And we would like to put in orders, sell limit orders below and also above. And the reason why is because sometimes price never even reach this here. It may get close, but we want to make sure we take advantage of our profit. And so we would still want to risk only 1 to 2%. And we'll even put some above. Now, I like to put a lower lot size order at the bottom. And the reason why is because if it goes against me and for some reason it goes past my 100 to 200 pip stop loss, I'm only risking, just a little bit because my lot size is low. Mm-hmm. Now, above the resistance level, I will put my higher lot size because we know that this is a high resistance level. So if it happens to go above, like in most cases it does, especially during the third pip, I'm gaining the most profit by using a higher lot size as it goes downward. And so this is an efficient way of actually trading, putting multiple lot size while you're still only calculating 1 to 2% by using your pip calculator.
And we like to swing trade and scalp in between. Well, Brian doesn't scalp. I like to scalp in between swing trading. So even when, let's say, if I'm holding a swing trade today, if I'm in USD/JPY for, let's say a 20-cent lot size, and tomorrow during New York session, I'm going to scalp. I'm still going to make sure that whatever open trades I have, I'm not exceeding 2% of my overall account balance. So if you stick with that, use proper risk management and take your lot size and avoid using really big lot sizes. I know it's enticing. I see so many traders who open a demo account and they're trading these humongous lot sizes, but they're not going to trade that in a real live account. That's setting you back and you're setting yourself up for failure. You really need to take risk management very seriously and learn how to use proper position sizing and then correlating that or using that with the appropriate stop loss. Okay, so we hope that this video is very helpful for you. This is what we teach our students in our academy, and we do a lot of risk management practice because this is one of the most important skills that you need to develop in order to be consistently profitable. So guys, if you have questions, comment on this video. We'll see you in the next training. Don't forget to hit the subscribe button and notification bell so that you'll be informed when we drop the next video. We'll see you in the next one.
Take care.